Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. In this session, let us talk about credit worthiness of borrower. This is the first thing which bank will look for before appraising the loan, right? If an applicant is an individual and let's say he is requesting for personal loan or home loan, then bank will try to understand the credit worthiness of the borrower by going through his credit history. They can peruse the reports from credit bureaus like CIBIL. They can go through the personal financial statement of that individual, and they'll give enough information so that the bank can take lending decision easily. Banks also have scorecard templates. Here applicants' financial data and loan request details will be filled in, and these templates are used for scoring the loan request of that borrower. By doing this, they can auto populate what is the eligible loan amount, how much EMI he should pay, and what is going to be the repayment period, because everything is going to be formula driven. Bank should also carry out due diligence exercise. Bank should examine that individual character, capacity. Character means whether he has intention to repay, capacity, whether he has adequate cash profits in his business. Bank will also make market enquiries. They'll also talk to that applicant's employer. Okay, so these are all going to form part of due diligence exercise. This is in case of an individual. In case of partnership concerns, private limited companies and all, banks can go through, or they can get a view of credit worthiness of the borrower by going through the financial statements, then credit reports. Okay, even for corporates we have credit reports now. Okay, so this is with regard to partnerships and companies. Then banks will also make discrete enquiries, search in CERSAI records, then register of companies, RBI defaulters list, then IBBI, that is the Insolvency and Bankruptcy Board of India. Then searches can be made with regard to encumbrances on the properties which they have proposed to mortgage. Okay, so in this way discrete enquiries can be made and credit worthiness of the borrower can be understood. And whenever bank is going to give advances to company, they have to carry out analysis of the financial statements of the borrower so that they can assess the credit worthiness. Here they should carry out complete analysis of financial statements, and for doing this analysis they should get all the necessary information, and they should also ensure the financial statements what is submitted to the bank is reflecting true and fair statement of affairs of company. It means it should not be with any qualification by auditors. It should be true and fair. If there are any aberrations that have to be noticed and inquired into, say for example, let's say the past 3-year period sundry debtors shows debtors is equal to average 3-month sales. That is, in the past 3 years debtors is equal to 3-month sales, but in the latest year it has jumped to 4.5 months. Then bank should inquire and understand why is that. Is it because of poor collection effort, or is it because market is slowing down, or is it because the product no longer commands the market share, there is no taker for the product, or is it because it is losing the market share to competitors product. All this have to be understood by the banker, because they are lending for their business activities, customers business activities, and business is going to slow down, it will eventually affect the banker as well. That's why we say there should be a complete analysis of borrowers financial statements. Okay, so not only for this, similar analysis and clarification should be obtained for all variations. Okay, wherever typical items are noticed, for all those items, clarification should be obtained. Okay, that's why we say complete analysis of financial statement should be performed. Bankers should get full information, and when they go through all the ratios, automatically they get enough hints and cues so that they can obtain full information and take a better decision. Okay, so with regard to companies, or not only companies, all borrowers, understanding three elements is very important: solvency of the borrower, liquidity of the borrower, and profitability of the borrower. So these three will give prima facie conclusion as to how sound they are when it comes to financial stability. Okay, or we can say the financial soundness. That is, these three: solvency, liquidity, and profitability will communicate financial soundness of a company. Here, let's go a little deeper into liquidity. What is liquidity? That is, liquidity means the company has ability to meet demands when it is made. When current liabilities, when suppliers, when employees are going to ask for their due payment, company is in a position to meet that demand. That's what we say as liquidity. So it can arise from, the demand can arise from creditors, trade creditors, other dues payable, tax dues and all. Okay, so a bank or a lender, before giving a loan to a customer, they have to check the liquidity position of the borrower. And how they can be convinced that this customer is having enough liquidity? This is measured by surplus of current assets over current liability. If current assets are greater than current liability, then we can say there is a liquidity, and that can be measured through a ratio called current ratio. Okay, this ratio is calculated as current assets divided by current liability. If current ratio is greater than 1, then we can say there is liquidity. If current ratio is below 1, there is absolute liquidity strain. Company is already facing liquidity constraints. Okay, now let's see this. When current assets are more than current liability, we can conclude that company has ability to meet the demands. They can realize their short-term assets, that is the realization or receipts from current assets, and with that they can meet the current liabilities. So this is going to be a continuous process, that is realizing current assets, meeting current liabilities, realizing current assets, meeting current liabilities. So it is a continuous process. So this is basically issue of cash flow management, we can say. It is an issue of cash flow management. And I said current assets should be greater than current liability. It means current ratio will be greater than 1. Is it okay if it is just greater than 1? Not just greater than 1. Current ratio of 1.33 is considered as a satisfactory ratio, not mere greater than 1. If it is 1.33 or greater than that, then we can say liquidity is very satisfactory. If you look at Western countries and all, for large companies, higher current ratio was prescribed by their system. It was expected to be in the range of 1.5 and 2. That is, current ratio should be 1.5 and 2. Right. But thanks to financial sector reforms that have taken place, here banks can now draw their own conclusions with regard to what is satisfactory current ratio. So what is good ratio, what is good risk, everything can be decided by the bank itself based on their internally developed lending models. But one thing is very clear: if current ratio is going to be below 1, and if a bank is going to take up a fresh exposure on those companies by giving loans, it is equivalent to suicidal. Okay, this is on liquidity side. Next, let us also talk about solvency, that is measured through debt to equity ratio. Okay, this ratio basically measures the financial leverage. We said current ratio should be greater and greater, I mean greater than 1, greater than 1.33 and all, right? But for debt to equity ratio, lower the ratio, it is good for the company. When the ratio is lower, it means there is larger involvement of the company. Promoters, when they contribute more, the ratio will be lower. But if the ratio is higher, it means there is a high debt and it indicates the company is heavily dependent on creditors, and promoters are trying to play the game of a leverage. They are trying to keep their own stakes lower, and they are trying to run the business with outsiders money. Okay, this is debt to equity ratio. There is also another indicator of solvency. What is that? That is interest coverage ratio. This ratio is calculated as operating income divided by interest, and higher the ratio, it indicates the company has more ability to meet interest payment obligations. Okay, and it also helps the bank to ascertain whether it is difficult for the company to meet the obligation, or whether they can manage the repayment, interest commitment and all without any difficulty. Okay, so both the ratios, that is debt to equity ratio and this interest coverage ratios, they measure the impact of external borrowings on the operation of the company. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like ad hoc credit facilities, letter of credit and all. So far I have introduced 7 courses of 1999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral security is a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.